Hello, Uncle Jim here. Did you know you can make really good passive income selling options? Today, I want to share with you two stocks that I really like for the put strategy, which is one of the safest option strategies out there. I'm going to go into detail about these stocks, why I like them, and I've actually been selling puts on them for a long time. I've made quite a bit of money, so stay tuned. I think you're really going to enjoy what I have for you. Okay, let's get started. Now, before I share with you the two stocks that I referred to in the intro, I do want to share a little bit more of my philosophy with selling options, especially selling put options. So, first of all, I've had a lot of questions related to when I close my positions, but I want to emphasize I try to pick stocks that I really want to own. So, a lot of times I'm okay with assignment, and I typically won't sell puts on a stock that I don't want to own. Now, I do try to make some income selling puts, and I do that primarily by selling puts on the Russell 2000 on the ETF for the Russell 2000. And that's the only exception, and that's a little bit different. I do think it's a little bit safer. So if you're just wanting to make income, I would use something like SPY. I chose the Russell 2000 ETF. Mainly because it doesn't move quite as much. It stays in a or not small range, but a smaller range than SPY. So this doesn't really relate to those kind of investments or those kind of options trades. It primarily relates to when you sell puts on stocks. So when I do get a lot of questions about, when do I close out or when do I, exit a trade, a lot of times when I go in, I'm happy with the strike. I'm happy with where I'm picking up the stock. So I'm okay with assignment. And I've had a lot get assigned, and some of those have done really well, others not so much. The ones that have done well recently, BP has done really well. It was assigned to me and it's up like 30-40% currently. And I'm selling calls on it and doing quite well with those now too. Now, one that hasn't done well, Lumen, Lumn, it bombed. I think it's trading at like 250. I think I picked it up at 750. So I'm holding on to it. So if you do have some that are signed and you're not quite sure what to do with it, I'm using it to kind of hedge against my profits or to lower at the end of the year the profits that I make. So I'm looking to probably sell it. I'll look at how I do this year and how much profits I bring in. And if I do bring in a lot of profits with some of my other trades, then I'll sell Lumen and take that loss to counter those gains. So at least that's the way I'm looking at it currently. If I don't have a lot of gains this year, well, I may hold it into next year and then take the losses next year. Kind of all depends, because I do think 2024 we may go into a bull market and it may be a little bit of a better market than it is this year. I think we're going to continue to go sideways and maybe down. I don't think we're going to test new lows, but I could be wrong. We may test new lows. And then another point I wanted to make too was when you sell options, it's almost like you don't want to diversify too much. I went chasing different stocks and different ETFs, and now I'm sticking to maybe a dozen or 18 stocks and ETFs that I typically use, and I'm finding that works out a lot better. So really, diversifying too much with selling options is not necessarily a good thing. So I suggest you like me, you stick to a smaller number of stocks and ETFs and primarily trade on those versus trying stocks you're not familiar with. Because once you've been trading with them and even selling options, you start to get an idea of those companies and how they move, where their stock price, where it goes depending on earnings and different criteria. And also you get a feel for how much debt they have, how good their management is. So again, another reason to probably not be too diversified and stick with a smaller group of stocks. Now, when I'm actually selling the puts, I try to find companies that are pretty near their 52-week lows. And then at that point, I look to try to pick them up 10% below where they currently are, which usually corresponds to between a 15 and a 20 delta, closer to a 15 delta. But, if you can get a 10% improvement when you're purchasing it and it's already pretty close to the 52-week low, you're picking them up at a really good price. Another important point I like to mention is and I would think this is common sense, but if you're new to options, it may not be. If a stock is down, then it's a good day to sell puts. And if it's up, it's a good day to sell calls. And that's pretty consistent. Now, if the overall market is down, but that particular stock is up, well, it still holds true. You want to look at the particular security. So if it's an ETF and it's up, it's a good day for calls. If it's an ETF or a stock and it's a down day, then it's a good day for puts. And that has worked out really well for me in the sense that it minimizes. I like to get on and get off. I typically don't trade more than an hour each day. Some days I'm only on the market for 30 minutes, and I try to do one trade a day, and I try to make about $100 a contract and do per trade with 2 contracts, meaning I'm trying to make 200 per trade each day, which comes pretty close to 4,000 a month, and that's my goal, is to try to make 4,000 a month just with selling options. That doesn't even include my dividends. I'm shooting for 2,000 a month with dividends for each month by the end of the year. At least that's my goal for the end of the year. I'm right around 1,900 now, just shy of 1,900. So I do think I can probably make 2,000. I pick up one or two more quality companies paying good dividends. I should be right there at that point. And then I typically will do 30 to 60 days out. Sometimes I'll go farther, again, because what's more important to me is earning the right amount of money on that contract. So if I can bring pretty close to $100 per contract, if it means going out 90 days versus 60 days. Sometimes I'll go even 4 months out or 6 months out, especially with covered calls. Covered calls are a little bit different strategy. So there's other videos where I cover those. You might want to take a look at some of those other videos. But in this one, I'm just talking about puts. So I typically don't go out farther than 6 months with puts. I have, but typically I don't. And again, it relates to trying to earn pretty close to $100 on each of those contracts. So if it's a cash secured put, then $100, just with the one trade or the put I'm shorting. Now it's a vertical put credit spread, and this is a little confusing. I had to share this through a lot of comments. So I typically always start with a cash secured put. Then I look to see, can I purchase a put about $10 out on the spread? So let me give you a quick example. So if it's a $50 stock, I'll usually look right at the $40 range. Can I buy that put pretty inexpensively? And if I can, then I'll turn it into a vertical put credit spread. And it's just the difference. So it's $10. So I sell a $50 put, and then I buy a $40 put, and I need less cash. I need less margin, because if the stock goes below that 40, then I can put it to someone, and it also gains value. So as the stock goes down, mainly, if you're in a bear market, which we are, and it goes down below that $40, well, that value of that option keeps going up in value. So it minimizes the kind of losses you can take. And that's why you typically need less cash or margin for a cash secured put versus not a cash secured put, a vertical put credit spread compared to a cash secured put. Because for a cash secured put, you need to cover the entire price of the stock. So if you do a cash secured put for the $50, well, you need to have $5,000 to cover that $50 purchase on those stock or for that stock. And then I also wanted to mention, I try to manage my contracts going about 3 weeks out. So I don't like to wait to the current week. And I used to do it 2 weeks out. Now I'm doing it more like 3 weeks out. And if I have stocks that are deep in the money, then I typically will go even farther out. Like I currently have, I think, 4 different contracts with Schwab, and they're very deep in the money. So I'm trying to manage them now, looking from time to time to see if I could potentially roll them. And that gives you time to actually, work with the trade, decide what you're wanting to do. Can you roll it? What kind of things you could do. And if you can't do anything, just sitting on it. So I've been sitting on Schwab for a while, and it hasn't been assigned to me. And I believe one of them is almost $20 in the money. It's at $70, and I think Schwab is at $50. But I really like Schwab, and I do think come 24, they're going to be probably back in the 70s or 80s again. So Well, that's it. Next, let's turn to my two favorite stocks. Currently, these are two stocks that I'm working with that I really like, and I want to own them. I currently don't own them, so I'm actually selling puts on them at this point. So, and I'm going to talk about the fundamentals and go into the option chains just so you can see how I think and why I like these specific companies and why I'm actually selling puts on them. So stay tuned. Let's jump into the next part of the video. Now, the first company I want to talk about is Devon Energy, and I've been selling puts on this for quite a long time. And it's a good company, well run. It pays a fairly good dividend. You can see here too, it doesn't trade in a huge range either, which is nice. The 52-week range is 44 to 79, and it currently is at 55, so it's kind of right in the middle of this range. And you can see here, it actually went down quite a bit back in March, and then you can see the high. So it's moved quite a bit, which has worked out pretty well for me. I've been able to, I think, sell primarily vertical put credit spreads right around the 50-40 range, and I've done quite well with them. Here you can see the moving averages, the 50-day, the 20-day. It's in a fairly small range, which works out quite well. And then with earnings, it's slightly missed earnings last quarter, but it's done quite well. And you can see the PE is really low. And then dividends, it's currently, a 9% dividend, which it pays a variable dividend. So I don't know if it's going to continue to be paying this amount of the dividend. But you can see here it's gone a little crazy with the variable part. But you can see it's got pretty good coverage, 174% dividend coverage ratio, and payout ratio is 52%. So it's got plenty of cash to pay more dividends, and I think it's going to continue to pay quite a bit of dividends. So, and currently it's at a really good price, and it always has quite a bit of option activity. If you come over here, you can see it's got plenty of option volume, and this is the open interest. If we go to Greeks, well, you can see all the different, so you have a lot of choices. You've got pretty close range of strikes. If we go out, let's go out to May 19th, which is a monthly expiration. So you can see it pays some really good premium now. It's being that it's fairly low. I think it may be up today. What's it doing today? Yeah, it's up. So of course the premium is going to be lower for the puts, but you can see the calls. Actually, it's not paying really good premium today, so that's kind of unusual. Usually it does. So 21 premium is right around 56. Am I back at 1 day? Yeah, I'm back at 1 day. So let's come out here. So here you can see it's 60, which is a 26 delta. It's paying almost $100, which is nice. So it pays nice premium on both sides. It pays nice premium for puts and also for calls. And again, with it being up today, it's not a really good day to be selling puts. Now I wanted to take you over here so you can see these are all the different contracts that I've opened. So here's the latest one that's currently open that is expiring on May 19th. But you can see I've opened quite a bit going all the way back. Well, but here's December, November. I started back in July, so not even a year, more like I guess it's 9 months or so, and you can see I've made 1345, and this is just selling puts with two contracts, vertical put credit spreads. Again, I've had different wideness for the spreads. I think here you can see I started out with an $800 spread versus a $1,000 spread, which is typical for me, but right now I currently have two contracts, and I believe they're $10 spreads, which turns out to be $1,000. And so with doing all these trades, I've made $1345, almost $1346. So you can see it. You can make some really good income with it, and it does move. At times, it's gone into the money, and then it's come out of the money. Currently, it's out of the money. Like I said, I believe, what is it, 56? Let me go back here. Yeah, 55. And again, my short over here is at 50. So it's pretty far outside the money. And it's probably been more outside the money. That little dip it had back in March is, I think, one of the only times it's been in the money. So it's been a really good company to sell puts on. And like I said, I've done quite well. I've actually thought maybe I should take a little bit more risk because I do really want to own it, and I do like its dividend. You can see from a minute ago it pays a really good dividend. So that's the first stock. Now let's jump to the next one. Now my next stock is actually Camping World, and some of you may be questioning why would I have Camping World. Now it's had a little bit of a tough time recently, but its numbers look really good for next year, and it's been very, very profitable for me. I've been selling options on it for a fairly long period of time, and then have done quite well. And for a fairly inexpensive stock, that's really nice. This is one you could definitely trade in small accounts. So let's take a look at it. Let's go to equity. And here you can see it's down near 52-week lows. It's 21. It looks like it's up today. But the low is just shy of 19, high of 33. But I believe the 33 was quite a ways back. And so it's taken a little bit of a hit recently, and a lot of that has to do with the fact that it depends a lot on interest rates, and a lot of these RVs, people aren't purchasing as many this year with such high interest rates. But if my prediction is correct and rates start lowering, especially towards the end of the year and maybe into next year because we've gone into a recession, they could have a really good 24. And that's what their early numbers look like, their projections going into 24. So it could be really good. So a lot of that issues with the interest rates for this year have already been priced in, and that's why it's so expensive or inexpensive. Then we come down, you can see here's the different, you've got the 10-day or the 20-day moving average, $20.20, the 50 days, $22.55, the 200 days, $25.46. So again, if you saw the put on it currently, you could pick it up probably pretty close to $18 and make some pretty good money selling puts on it. Now again, it's not doing as well. It did take a loss in the latest earnings, but I believe its revenues are still up and it's still doing pretty good cash flow. There has been a lot of rumors that maybe they're going to cut their dividend because they are paying $2.50 and the stock is, again, what is it, 19? Let's go back up, 21. So it's paying a pretty big dividend, almost 12%. So there are some people thinking that they may decrease it, but they recently increased it. And if we look at their dividend coverage has come down. At one point, I believe it was close to 200, but they still have a fair amount of cash. And so I don't know that that's correct. I don't know that they're going to decrease their dividend. They may, but they haven't recently, and their cash flow looks pretty good. And if you look at forward PE, it is a little bit higher. So it is definitely risky. Like I say, with any of these, please do your own due diligence. It's worked out well for me since I've been selling puts on it. But again, do your own research. Be sure it's the right kind of investment for you. Here you can see the balance sheet. Let's look at the income statement. So you can see the income's been increasing, but along with that, and expenses have also been increasing. But I believe I've seen some projections for 24, and it should be significantly higher. And I do think more and more baby boomers. I have several neighbors who are in their 60s and 70s that have have RVs, and I know of others that want to buy them, and they're just waiting currently, mainly because they think interest rates long term will come down, and I think they will. I don't think we'll ever see the levels we saw a year ago. I think we're going to have a 3 to 5% interest rates probably for the next couple of years, maybe even longer. So again, CWH has worked out well. This again is Camping World, and you see them a lot if you as you're driving around. If you're heading to Florida, and you'll see them at the side of the exits, like on 95 and 75. So it's interesting. I've almost played with the idea of stopping and taking a look, but I don't know. I don't know if I would enjoy that or not. But it's something I might try. I may rent one and see what it's like. But if we come over here, I did want to show, so here's the different trades. And this isn't the only account that I've traded these in. So you can see going back to, what is that, 5/20/22, I've been selling puts on them. And the short was 24. Well, I started 20. These are all cash secured puts. So I started 20, went to 24, went to 20, 24. Some of these I closed for an inexpensive amount, so I did close some of them early. But overall, like the current one, I have one expiring on 6/16/23/22, so it's a little bit in the money. It's $1 in the money. And I picked up 314, and I spent 135 closing the prior position, which was supposed to expire on 317, and I actually closed it on 208. So I had it for more like maybe 2 months versus the 3 or 4 months. So that's another point. Sometimes I'll sell these puts, 90 days, but rarely do I ever hold them 90 days. Usually I will close them and roll them again, especially if they're fairly far outside the money. But here, total, I've made 1,030, and again, these are all cash secured puts. And I typically have done 2 contracts, so I've needed 4,000 in capital. Again, just in case they get assigned to me, 2 contracts are 200 shares at $20 to $22 per share. That's right around $4,000. So, a little less than a year, and I've made $1,000 just selling puts, which I think that's like a 30% return just selling puts on Camping World, and it's worked out quite well. And again, this isn't the only account. I think I've made another $300 or $270 in another account. So that would bring this close to $1,300. I think this is the only account that I currently have a position in. I had sold one, I believe, in a brokerage, but I have stopped doing that. I'm doing a lot more of my cash secured puts in my retirement accounts, and this is actually one of my retirements, one of my IRA accounts. Oops, didn't mean to show that, but it's an IRA account. So that's it. Those are the 2 companies, Devon Energy and then Camping World. And again, do your own due diligence, but they've worked out really well for me. I've made good money with them. I currently don't own them, so I'm going to continue to sell options on them. I might actually take a little bit more risk because so far I have not been assigned, and I want to get assigned with these. So I may even take more risk and do a slightly higher delta than I have in the past. So hope you enjoyed that. Thanks for joining me, and have a wonderful day.